I'll let you kick us off.
Sounds good. Thanks, Tony. Nice to see everyone today. I hope you're having a great time at CSCMP. My name is Gabrielle Francisco, and I'm an Enterprise Customer Success Manager here at FreightWaves. Prior to FreightWaves, I've got about 6 years experience in the logistics and trucking industries, both with asset-based carriers and then about 3 years with J.B. Hunt, where I went on to manage my own book of business of about $100 million annual revenue, both on refrigerated and the dry van side. So lots of pricing, lots of customer-facing experience, and lots of getting into the data, which brought me here to FreightWaves.
And I'm Tony Mulvey, Senior Analyst of Economics and Transportation for FreightWaves SONAR. I've been with FreightWaves almost 5 years. I think it's 5 years and about 3 weeks, so coming up on that anniversary. Before that was in the golf business, so very different businesses, but my degree's in economics. So background in econ, kind of like to think as the bridge between what's going on in the macroeconomic space and what's happening in the transportation market, because they are so well connected. Even though you look at the US economy, it's 60% services, 40% goods. They're still quite connected. So that's what I tend to focus on. And what we're gonna do really through this whole presentation is kind of break down where we view with our SONAR data, where the market is, where we're kind of headed, and kind of tying that macroeconomic upstream look of what's going on at the macro level and dive into kind of each mode as you move kind of downstream. So starting with the maritime sector, moving all the way into the truckload sector by the end of it. So, and then feel free to ask any questions as we wrap up, but happy to answer anything.
Absolutely. If you have a question or a comment, feel free to raise your hand. Happy to make this as conversational and interactive as you guys want to make it.
Yeah, so I think really kind of highlighting what we're going to cover over the next, call it 30 minutes, really is where we're at, and it's setting the stage. I think when you look at the US economy, it's, especially from a goods perspective, it's two things, right? It's the manufacturing sector, industrial side of the economy, and the consumer. Really, you've had a tale of two economies with these two sides. You've got the consumer side of the economy that's been really driving everything since the COVID pandemic. Then you've got the manufacturing sector that's really lagged behind. It's been severely impacted by higher interest rates. Cost of capital is very expensive, and you don't make those investments into things that improve manufacturing, really drive that value. You don't make those when the cost is expensive. So you've got a manufacturing sector that's in contraction, you've got a consumer that's driving the economy, and then you've got a cooling labor market, which leads to interest rate cuts, thankfully, for those manufacturers. And then kind of tying it into transportation, you've got import levels at record highs, or you've had them at record highs, and we'll kind of touch on looking further upstream before they ever get to the port, what that's telling us. You've got an intermodal market on the rail that's booming. I mean, you're talking up double digits, but it's been primarily international versus domestic, but you're starting to see that gap close. Then you've got a truckload market that remains oversupplied. I think everybody in here could probably attest that finding capacity right now is quite easy. But there's some signals that maybe come middle of 2025, that market's ripe for a change. So seeing trends that are positive, moving in a positive direction, looking for that inflection point probably in 2025. So I'll start really at the macro level, just because it's there's so many components to it. And the first one here, we've got a chart pulled up. It's the ISM PMI, so Institute for Supply Management's Purchasing Managers Index, kind of a gauge that we like to use as the boots on the ground, what's happening at these manufacturers. It's been in contraction for 21 of the last 22 months. So you're really seeing, it's not a dramatic slowdown. I mean, relative to the strength we saw kind of in 2021, low interest rate environment can make a lot of investment, really having to ramp up to meet consumer demand. As that kind of trickled away to some degree, you've seen a contraction in the industrial side of the economy. Eventually, though, you will see kind of some inflections. I think the concern here is it's the pronounced length of this contraction. It's actually longer than what we had in 2008 and 2009. So to kind of put it in perspective, this index, anything above 50 indicates contraction or expansion, anything below 50, contraction territory. So really the length that we've been in contraction is the part that's really why we felt the market has been as soft as it has been from both a volume perspective, and then you added so much capacity during that COVID cycle that really kind of makes it feel worse than it actually is. Then you start looking at the consumer side. So retail sales really starting to flatline. So in that white line, you've got total retail sales across the US. So this comes from Census Bureau. It's no different what they look at, it's just the aggregated number. I think what's interesting here is what's happened recently. So you had a July that was really strong from a retail perspective. Then you had an August that many expected to be a significant slowdown in spending. If you think about it, month over month numbers, if you have one really good month, you have to increase past that to have that strong month the month after. You had a really good July, kind of set the stage for a slower August. Didn't happen. You actually had an increase, 0.1% month over month. I mean, expectations were for a decline of, I want to say it was in the 2% range, so fairly big slowdown month over month because July was so strong. It just didn't happen. So to me, that's a signal that, hey, the consumer is still spending money. They're willing to spend money, whether it's a positive sign or a negative sign from the consumer perspective, because if you look at savings rates, they're depressed. I mean, they're well below the pre-COVID levels. I think they're down in the 3% range. Kind of put that in perspective, about 5% of discretionary income was saved prior to the pandemic. So depressed savings levels, but spending continues to rise. Some of that spending, when you look at retail sales, it doesn't factor in inflation. And I think that's a part that kind of gets lost sometimes, especially when you're looking at the headline number, is inflation does strip away from retail sales. So maybe volume is down slightly, marginally, because inflation's up. But overall, in terms of dollars, you're seeing that increase still continue. You've only seen a few months where you've actually seen a contraction in retail sales throughout, really dating back to 2023. So that's one area kind of where you can really you see the contraction side of the manufacturing with the ISM, then you see the consumer side continuing to grow. Now, one of the things that I like to preface that with is, well, one, you're seeing a cooling labor economy. So I think it's no surprise. I know the Federal Reserve or Federal Open Markets Committee, when they were debating at their September meeting about the interest rate cut, and really debating it all year, they were looking for positive inflation data, which they've got. I mean, if you look at their preferred index, it's down to, I think, 2.2% annually, which is kind of getting in line with the long-term target of 2%. And then you have the labor market. Unemployment was low. I mean, I think most recently touched 3.9% earlier in the year. It's ticked up since then, but I mean, it's still in the I think it's 4.2% in the latest reading. It's fairly low overall, but you start looking at the number of job openings on the decline. You've gone from an economy where you basically had 2 openings for every unemployed person in the US, and that number has started to trend back closer to 1. I think it's in the 1.3 range now of openings to unemployed. So seeing the labor market clearly cool off, I think that's one of my favorite indications, is how many openings are there to unemployed, because ultimately those are the jobs people are searching for. The other flip side is you've had this rise in part-time employment that kind of gets lost, especially when looking at headline numbers. I think you have to dig into the employment situation to really see it. You've got an economy that you've added, it's like 1.1 million in full-time or part-time employees over the last, call it year, 18 months. You've actually seen a reduction in workforce in the full-time sector over that same period. So definitely interesting kind of dynamics that are happening in the labor market, and kind of all this together leads to where we are with interest rates. So we've got here Fed funds rate We pull it monthly, but if you were to go look at it right now, it's down the 50 basis points that the Fed cut just a couple weeks ago. And when you start looking into their release, you're looking at another 50 basis points total coming before the end of the year, which frankly is a positive sign from a demand perspective. It helps drive it. We've been in this higher interest rate environment. We started raising kind of early 2022, kind of stalled out, stopped raising, call it August of last year, and been at just over 5% since then. Really hard to justify going and spending money, making investments when you're getting 5% returns by doing nothing. So that's hence the reason why demand's really slowed and there hasn't been the investment made in the manufacturing sector. But now you're kind of getting the tailwind that's going to come by interest rates starting to drop. Now, will it be felt immediately? No, it wasn't felt immediately on the way up either. You're really starting to see the impacts of higher interest rates take hold. That higher interest rate environment, you're seeing consumer delinquencies on things like auto loans, credit cards, that's starting to tick up. I think they're at the highest level they've been in over 10 years. So you're seeing things like that start to tick up, but there's some favorable signs on the way. So you get another 50 basis points before the end of the year. You're looking at another 100 next year. Kind of presents, especially the housing market that's been so under some stress, really the opportunity to grow as we enter 2025, which is frankly what we need to. Consumer demand has kind of been there. We need that manufacturing side to really boost the freight market into 2025.
From a client-facing perspective for SONAR customers or other clients who are looking at this data, what inflection points should they be looking for through the 5 slides that we've just shown?
I think the big one's going to be that manufacturing sector. Once you see that, and not a one-time blip, right? I mean, we were talking 21 of 22 times that it's been in contraction. You need to see that expand for, call it 3 months. I mean, I don't like to call it trend. 3 months is probably about right, where you see it in expansion territory. It doesn't necessarily need to, we can go back to it. It doesn't need to go to the COVID levels that we saw coming out of the depths and money was cheap and it was really easy to do things or spend that money. I think what you really need to see is just kind of a sustained growth. I mean, if that ISM PMI, again, anything above 50, it stays in that 50 to 55 range and kind of hovers in that. That's pretty good indication that that side of the economy is growing. And I mean, ultimately, if that's growing, you're going to see freight demand kind of come with it. So I think that's really, from my perspective, is what you're going to look at. Now, granted, is it the perfect indicator? No, but I think it gives some insight to what's happening overall when, if you look at some government data, I mean, it can lag 3-6 months behind what's actually going on in the market. You're kind of getting a boots on the ground from their survey, like what is the actual experience we're having right now. That the government data, while it gives great numbers and it's quite useful, it kind of misses that mark of the expectations or where we're headed from what's happening in this very moment, and is it us sector specific or is it broad macro specific? And I think that's what, if I was looking for it, it's just entering expansion territory and staying there. So then it kind of leads us into the freight market. And I look, today's a big day, right? You've got the International Longshoremen's Association strike that happened starting at midnight last night. So probably the hot topic going on, but you start looking at and what's happening. I sat in a session yesterday where from Walmart and Grainger kind of talking about that pull forward. And I think this chart amplifies that. So looking at this, it's our inbound ocean TEU volume index. So it is a measure based on bookings overseas. So as these TEUs are departing ports overseas, it's indexed. But it kind of gives you a gauge of, we're looking what's coming, call it 30 days in advance, because when you factor in the lead times and the transit times, you're talking upwards of 30 days before these goods hit the port. You can see That ramp that we saw, I think the highlight here is one, it's a kind of busy chart. You look at it. We're running elevated to where we were in 2020 or 2021, 2022, and 2023 at this time. So, I mean, you're having now granted, 2022, you had seen the kind of slowdown in imports really start to take hold by this point. But I mean, you're still at COVID-like levels as we enter, or kind of end of September. Really started to see it fall off. I think you look at it from the perspective, a lot of that pull forward happened in June, July, August, and now we're starting to see the slowdown. We'll see a big dip. You see the big dip in October every year, so that's Golden Week. To kind of put it in perspective, you see the big dip in the first quarter, Lunar New Year, big dip in October being Golden Week. So expect to see that again, that slowdown. But where we are right now, I mean, is elevated. That's why you're seeing record volumes at the ports across, especially on the West Coast. Yeah, good.
Do you think, how much of that has to do with customers knowing that the strike was happening, that they were pre-ordering in June?
I think a lot of it. I think it was more of that. I think there's some tariff risk that helps add that. You've got the election, right? So the good news about, when I look at this, the strike, it's been kind of well known, right? It's been talked about. I mean, I started talking about it really in depth, call it 2 months ago. So you kind of have a 2-month lead time. You want to think transit times are about 30 days or so. So you've had opportunities to move that freight inbound for quite some time. I mean, Gabby, you talk to customers way more often than I do. I mean, what have they said? Is it really been driven by
We have been seeing from our conversations with customers who are looking at this data, looking at the transit times, the rejections from ocean carriers that we track, along with the spot rates, which we'll see in the next slide, that we're seeing, upward demand in either capacity constraints or just upward pressure on those spot rates, because our customers are continually coming to us and saying, okay, we need to make sure we pull forward so that we're not having that opportunity cost of not having that freight on the shelves later on this year, with that 3-month lead time that CPG customers usually see due to this strike. And I think really the difference in this situation versus other strikes that we've talked about this year are that really both sides have seemed to dig their heels in, and it seemed like that approach much earlier on. And so I think a lot of the shipper customers were taking heed to that, especially on the larger scale. Some of these smaller shippers who may not be utilizing this data or, looking at resources like these may not have had that same strategy or the ability to do that pull forward, and they might feel, some of the effects of that.
Yeah, absolutely. And I think moving into kind of ocean spot rates, I think one of the things that gets forgotten now, because the ILA strike has kind of taken hold here in the US, is there's still conflict in the Red Sea area, and that's still causing capacity constraints on the ocean. I think it's a 37% added transit time to go around the Cape of Good Hope, like most of the ocean carriers are continuing to do, because they ultimately don't want to put their vessels at risk. It kind of lost the headlines, but it's still happening. And so to do that, if demand stays stable and you have a 37% increase in your transit times, you've got to allocate capacity slightly different. And that's what the ocean carriers are doing. And ultimately, that's what led to kind of this ramp up in spot rates. So ocean spot rates didn't quite touch the COVID levels, but I mean, you're still talking $10,000 a container from China to the US East Coast just a few months ago. So some of this is a factor of, this increase is a factor of supply, those capacity constraints, and other factors, the demand side. So what we talked about before, strong demand. If you got strong demand and constrained supply, prices go up. So I always like to think of talking about transportation. It's kind of an economics 101 like crash course, because everybody wants the outcome, and that's pricing and rates and things like that. But there's two sides, the fairly open market with the supply and demand perspective that set that price. Ultimately, that's the root of economics. So I like to always think of it that way. what you're basically seeing, I think what's interesting here is you've not seen, to me, you see this slowdown off the peak, but what you really don't see is just a complete collapse like you saw post-COVID. Kind of indication as kind of a, I don't know the right word. I know the right word, it's slipping my mind, but kind of gives us that insight that the demand we saw in the slide prior or the chart prior is actually there. It's not really falling off super significant in any way where ocean carriers are, desperate to fill their vessels with excess freight. They're kind of comfortable, and if somebody's willing to pay a premium, they're going to take it. But right now, they're not in a we need all the freight we can get, because demand, again, continues to kind of stay relatively stable and at elevated levels. And I think that's, again, from a consumer side, that's a lot of what this pull forward was. So this is, I've seen the headlines talking about retail season not being disrupted by the strike. You saw that ramp up really starting, call it May, into August. I think that's why you're really not seeing the risk of, call it holiday retail, fall away. I mean, I walked into a Walmart yesterday and Christmas stuff's already on the shelves. So a lot of that stuff is already here. Big savvy shippers that utilize, have networks coast to coast, are able to flex the kind of ability. And I think that's showing up overall. I think the next one's really fun. You can look at intermodal, and the Association for American Railroads does a great job in breaking down overall intermodal demand. And you look at rail traffic on a weekly basis, but I think it misses one thing. You've got the international side of the market, so those 40-foot containers that the ocean carriers have, they lease, they send inland, and then you have the domestic side, so your J.B. Hunt, Hub Group, and the like. They're two very distinct markets. I mean, and often they're thought of together. They really should be thought of as two distinct markets, because ultimately the clients moving it are somewhat different, right? Those domestic containers never leave the continental North America, right? They may go cross-border into Canada or Mexico, but ultimately they're staying here in North America and not headed back. So what you've seen really all year is just growth on the international side. Really makes sense early in the year when you saw demand kind of waning. Ocean carriers could send containers inland. So they were comfortable sending those containers inland. There wasn't like a time crunch to get them back. What we've seen recently is it's really fallen off. You've seen an increase in empty container volumes, especially on the international side, headed back to the West Coast to get loaded. So if they went inland, say, call it July and August, you're really seeing it amplified, getting those containers back into the West Coast. You're also seeing an increase in domestic volume, empty volume headed to the West Coast to service that freight. If the international containers aren't going inland, they're getting transloaded into those 53-foot domestic containers. That's why you've really seen kind of an acceleration in growth as you see these two charts, or two lines in the chart come together. It's on a relative view. So the green line, loaded international container volume over the course of the last year, up about 12%. I mean, at the height, we were up about 20% kind of earlier this month. Part of that has to do with the holiday, Labor Day holiday, and the way we measure this. But I mean, we've been up about 10% all year, starting to retreat from recent highs. Meanwhile, the domestic side has really started to find some momentum year over year. And I think we'll look at it here in the next chart. It really highlights it. We're sitting basically at all-time highs when you look at domestic intermodal volume. I think when you start to look at the market, and Gabby chime in, intermodal, specifically domestic intermodal, the value prop right now is fairly attractive from a shipping perspective. If you look at intermodal spot rates, fairly small percentage of movements, but they're relative to truckload, they're quite inexpensive. And the time-sensitive nature right now that you need just kind of isn't there. So it's why you're seeing domestic intermodal volumes kind of explode to some degree.
Absolutely. That is another conversation that customers are coming forward to us with as we go into bid season, with the expectation that capacity should continue to contract, very much depending on what we see with volumes now that we have the looming strike. But Intermodal did have some reduction in their rates over the course of this year, which allowed them to claw back some of that market share. I like to think of intermodal and truckload as two sides of the same coin. One usually sees an increase in rates, and the other has that opportunity to kind of get back some of that volume and add that value. I also want to mention that intermodal service has also increased, and I think that's another driver that is leading customers to start having that conversation, because when you look at putting things on the highway, it's been so cheap.
Yeah.
And the service has been there because we're oversupplied in capacity. But as Intermodal has been able to increase their service and take some rate cuts to get back some of that volume, that's where the discussion is really coming from.
Yeah, I think in past cycles, everybody kind of looks to intermodal and is like, why has it not been able to take share because of relative cost savings relative to truckload? I think some of that is a service component. The rails, I think it got amplified during COVID, and it's really hard to expand and build a new railroad, right? I mean, these things are 100-year-old companies in most cases. It's really hard to build that network, and it's fixed, right? Versus anybody could go buy a truck, have a CDL with call it 6 weeks to 6 months, somewhere in that time frame, and be on the road. So it's really easy to add that incremental capacity on the truckload sector. Now, on the intermodal side, you've had kind of a boom in capacity. I know recently JB Hunt on their second quarter earnings call, it was either second quarter or first quarter, talked about they could service 20% more demand with their added containers that they added to their fleet in recent years. That's part of the reason why you're seeing the truckload sector really it's kind of the forgotten capacity component of the market overall, right? And I think this next chart will really highlight it. So here we're looking at intermodal spot rates nationally versus our FreightWaves National Truckload Index, so our dry van spot rate inclusive of fuel. So both of these door-to-door spot rates both include fuel. You can see intermodal, $1.51 per mile. Truckload, $2.20 a mile with fuel. So you're talking 70-cent difference. You can see the reduction in the intermodal spot rate, basically dropping prices to the floor in an effort to kind of absorb any excess volume or any incremental volume that the intermodal marketing companies and railroads could kind of assume and kind of go grasp. Ultimately, you haven't seen a reduction. That spread is so wide right now, it adds that value prop, that the value prop for intermodal makes more sense at this level. If that number were to compress, and you have the timeliness, so as we get later in the fourth quarter, is where you'll really see kind of this, where you have to make decisions from a shipper perspective. You would have to make decisions of, does it make sense to continue to use intermodal where service is improved, but it's still not quite the premium service that truckload provides, but our cost savings is still gonna be there, where can we run the risk of missing a day or two of these goods not being where they need to be? And I think that's the part where really the fourth quarter is kind of ripe for a market that's changing, or show signs that it's in the process of changing before it falls back in the first quarter. I will say, I think the first quarter is setting up to be a pretty seasonal norm. But then you have the second quarter where I mentioned earlier, those interest rates, if they're falling, you're getting an environment where things start to become attractive. You start getting that investment back, it starts to help drive that demand.
Before we jump into the truckload side, what would be your recommendation as far as inflection points for both the maritime and the intermodal side that people should look out for?
I think the big one on the ocean side will be, well, one, what happens with the election and the risk of tariffs that come with that. Because I think when you saw it kind of really 2018, 2019, you saw a pretty big pull forward in freight. Now, will that how big of an impact will that have? How fast can it happen? I think it's kind of, and where are inventory levels? You've seen, Dr. Zach Rogers has a session after this with the Logistics Managers Index. It's also one of my favorite things. And they do a great job at breaking down inventory levels from an upstream and downstream perspective. So looking upstream, call it wholesalers, manufacturers, where those inventory levels are, versus the downstream, so think retail and the like. You've kind of seen a shift in inventory management strategies over time. We talked about just in time for forever. The retail space really has kind of gone back to that. The manufacturing side has kind of been more in the just in case. So if you were to look at upstream inventory levels for the past few months, they've been growing at the upstream level, upstream firms, downstream firms, those retailers, they've been contracting, so running fairly lean. You're starting to see some growth on the upstream or the downstream side. I think what you'll need to see there is kind of just a more balanced overall approach. I think once this strike resolves, how impactful is the East Coast going to be again? During COVID, you had networks break and you moved from West Coast, you had to rely on the East Coast because of the backlog. You had networks start to get built out on the East Coast. Well, now they're kind of thrown into a trance where you've got this strike, unknown how long it's going to go on, and then now you're moving networks back to the West Coast. It's kind of how long does that last? Is there some hesitancy to move things back to the East Coast once the strike resolves itself? On the intermodal side, I think it's going to be more time sensitive. When that ramps up, that'll be your inflection point. You'll see domestic volumes really start to kind of fall off. You may see intermodal pricing take another slight leg lower, but I really think what you're going to see is kind of flat. When you look at pricing on the intermodal side, it's flat, kind of year over year, maybe down a couple percentage points, but not really changing. Whereas on the truckload side, just where the market is, I think you have more opportunity for disruption as we move forward. I'll let you break down this one. I've talked a lot.
So looking at truckload volumes, again, the other side of that coin to intermodal, overall, volumes have grown slightly faster than the overall economy, which we can see is largely driven by the IOTI and those maritime volumes that we looked at in previous charts. About 70 to 75% of that maritime volume goes to the highway, so that's very much what we're seeing here. When we're looking at this seasonality, I don't believe we have the year on this chart here, but we're tracking very much in line with more 2019 levels. And we started to finally see this year more of the holiday bumps and troughs that we had previously seen. And so what that essentially tells me is that we are getting closer to that equilibrium point between the supply and demand. So that supply of capacity that we saw grow in COVID versus the demand, which are the volumes in the outbound tender volume index.
Yeah, and I look at this and I see grow faster than the overall economy kind of early in the year, and it's slowed down recently. I think the next chart probably tells the story better overall than in anything else. So we're taking that exact same index, but we're breaking it down by length of haul and looking at it on a relative basis. So relative, how things have grown or contracted over the course of the past year. In that white line, so city or local lengths of haul, think of it as loads under 100 miles. You're talking up 15% year over year. We talked about import levels being up double digits. Really, this is and you see that and you're like, well, demand kind of flat. If you talk to most people on the truckload side, flat to down slightly, and wondering why. Where is all the demand? Well, I think this chart really highlights it. It's all in local lengths of haul, moving from those port markets into warehouses. And I think that's an area that kind of has gone, I don't want to say unnoticed, but I don't think it was as recognized as it will kind of shows through this, that it's like where we're seeing this, and then you start looking at the capacity situation, it's like there's no volatility in this market, and there should be relative to, seeing growth in overall truckload volumes like we saw earlier in the year. I mean, you look at everything else, right? Anything from 250 miles up to 800 plus miles. So anything from that shorter length of haul, mid haul, to those tweener and long hauls. I mean, they're basically flat to down year over year. And that's the part that people are feeling. That's the part where most of these networks are built or on those longer lengths of haul. This is the part where the intermodal side kind of gives and takes, right? We've seen the intermodal side. It's grown significantly. It's taken share from these longer lengths of haul. And I think that's a component that when talking about demand, it often gets lost, that where these segments of pockets of demand come from. As we move later in the year, these goods that went into warehouses like in Southern California and the like, they eventually have to move inland, right? I mean, most of the population's east of the Mississippi or Ohio? I don't know what they say, but it's like 70% of the US population's east of the Rockies for sure. So, I mean, eventually that stuff has to move a great distance because it's got to go from LA to call it Dallas, Chicago, and there's not much in between in terms of freight consumption centers. So eventually this will likely change, but right now we're kind of seeing really still that growth segment being those shorter lengths of haul. I know we've got a question over there.
Yeah.
Does it work?
Yeah.
Perfect. Could you clarify if the data includes drayage moves, or is this just like over the road dry van type of moves?
So from my understanding, drayage is involved as long as it's tendered. So whether that's from large shipper, it gets a little more complicated on the drayage side or measuring it. Most of this would be considered over the road, but I do think there is an element of drayage to it, especially because if we were to pull up this exact same chart, looking at, call it Southern California, you're going to see this exact same thing. So leaving outbound LA, going 100 miles into that inland empire, typically a drayage day move, or less than a day move, right? You're keeping that truck in the market. I think that's what this does include some of that from that overall perspective.
Which is very interesting considering, we saw in the previous charts that sharp decline in intermodal rates. Mm-hmm. Prior to that, much of the conversation was around long haul volumes.
Yeah.
Really taking over the front running spot as far as moves, especially out of SoCal. We saw a tightening in capacity there in May around produce season and things like that, but they were all majority long haul moves. And what that can mean is, a tightening of that capacity, and it also takes longer to get those trucks back, especially if this strike ends up, dragging out longer and longer. There's not very much freight to return from those East Coast runs. And so during COVID and during the pandemic, everyone was going to California. There might be a rush back there with especially the larger carriers who have that ability to relocate assets. But it will put a strain on some of those more regional carriers since we won't have a ton of freight origination centers on that East Coast.
And I think it actually sets up a really good point. And I think that it can leave with, carriers flooding to the West Coast knowing that's where volume's moving. I think it can leave some of this East Coast exposed when the port strike ends. And I think that's the part to look out for because if carriers are moving equipment west, it takes a while to get, if you're trying to go from LA to New York, that is a long time to get back over there. So I think it leaves some of those that are staying in the market just searching for volume. They know volume's going to be coming out of the West Coast. They're just going to flood the market. So I think there's an ample opportunity for, a lot of available capacity on the West Coast, and it leaves kind of pockets of potential disruption once this strike ends. Now, the longer it goes on, the more likely that's a significant change. If it's a few days, it's probably not as big of a deal, but if it drags out for any meaningful time, I think that's where you add in. So here we've got our outbound tender reject index, or the way I like to look at it, conversely, tender acceptance rate, if you looked at it the opposite way. So you're talking a rejection rate, so as a tender's made, about 4 out of every 100, so what's that, 1 in 25 being rejected? pretty low number overall. I think to us, it's a signal that the market's still well supplied. And I think if you talk to anybody, finding capacity right now is quite easy. It's the demand side that's probably more of the challenge. But we're tracking 2019, but I think what's interesting when you look at it, it's really hard to see it in this, is that rejection rates really bottomed out in the second quarter of 2023. And they've moved incrementally higher every quarter since then. Even in the first quarter, they were slightly higher in the first quarter of 2024 than they were in the fourth quarter of 2023. And I think that's an interesting component. The other factor is you're seeing, like you mentioned earlier, Gabby, the holidays having a greater impact. You look at 4th of July, a lot closer to what we saw in 2019. You look at 4th of July in 2023, there was no impact. Tender rejection rates were 4%. It's frankly a soft market. It's deflationary for rates. I would say that's where we're at now, but you're not really seeing rates move. You've seen them move slightly lower, especially on the spot side recently, but you're not seeing, massive drawdowns in contract rates. I think shippers are fairly happy with where service levels are. So what this kind of indicates that service is there. You're not dealing with an influx of trying to find trucks. You look at it, 2020, 2021, and that blue and yellow line, you're talking 25% rejections, 1 in every 4 to 5 loads being rejected. Now you're having 1 in every 25. Makes life a little bit easier. But I think the holiday impacts, where you're starting to see some percolation around the holidays, I think that's what sets up kind of more optimistic look for 2025. We were hopeful we were seeing it in 2023 into 2024. It didn't materialize. I think if we see this follow kind of more that orange line that was 2019, where we have rejection rates around Christmas get to double digits, I think you're setting the market up. Now COVID added, 2019 into 2020 was setting 2020 kind of mid-year, setting up for a little tighter market, improving market conditions. Then you had COVID that kind of threw a wrench into all of that. I think you're setting up for very similar if we see this to move meaningfully higher. This, Gabby, I know when you talk to customers, this is one of the areas that you focus probably the most on.
Yeah, absolutely. We're looking at a national level here, but we have seen small green shoots at the market level across networks where, that capacity is starting to unequalize. And I think that's a big question that we get when we look at all of these indicators, especially upstream, is when do we go to bid? How much of our freight should we go to bid with at a time? Should we, focus on specific market areas where we've started to see tightening this year and understand, those tender flows in and out of those markets so that we can kind of hedge our rates if service is a big priority. And you can see with the next chart that we're going into, we're looking at spot market rates, versus contract. And so with your spot rates in white and contract in green, we really have seen contract pretty much bottom out. And actually had a slight increase through earlier this year. And so any upward pressure at all with spot rates when contract is this close means that carriers are likely going to move trucks off of your contract rates to go get pieces of that money, kind of like moss to a flame. They're going to go try to get some money back in their pocketbooks.
Yeah, I think it's one of those. We looked at the last one, and I think the other way to gauge it is carrier optionality in the market. A 4% rejection rate means, hey, they're willing to take contract rate. You look at this chart right here, contract rate, this one in the green line on that left axis doesn't include fuel. The one on the right does. So you're talking a 10-cent difference in one that the contract rate X fuel is 10 cents higher than the spot rate, including fuel. Doesn't have, that's kind of normal. You'll see that actually happen if we pull this data set, or if we actually have a different one that kind of measures that. You pull it back, even 2019, early 2020, contract was above spot, but that gap was, call it 25-cent difference when you remove fuel from the spot rate. Right now it's about 64 cents when you exclude fuel. So that gap is really what's driving kind of, hey, we're willing to stay in the contracts as that gap narrows is where carriers flex that optionality that they have in the market. They're more willing to kind of reject a tender to go play in the spot market to kind of figure out what works in their network better. But I do think it's interesting when you look at contract rates are really flatlined throughout the year. I mean, they've been, I think, in like an 8 or 9 cent range, which isn't all that's, I mean, you're talking 3 to 4% overall. I think what it sets up for is a market overall as we move into 2025. You've got the flurry of things, lower interest rates, clearly consumer demand's kind of still there. You're having capacity exit the market at rates not felt really ever. I mean, we have an index that we like to look at. It measures carrier authorities, the net authority exits. We had a boom throughout COVID. I don't think anybody's surprised by that, but the rate of exits really, it's kind of stayed fairly stable. I mean, we're losing about 200 authorities to between 200 and 300 authorities a week. Not a great proxy for the amount of trucks, because you can have an authority that has 1,000 trucks or 1 truck. But overall, I think to us, it's a signal that, hey, capacity is leaving the market. Now, when's it come into balance? And it moves in waves. I mean, it was really slow to react during COVID. Demand moved before capacity did. Capacity reacted. It was really slow to see the reaction when demand started to kind of fall off there in 2022. People are still entering the market. It's going to be slow to react on the other side. Eventually, it will go too far. We will cut too deep, and you'll have some volatility enter back into the market. It's just a matter of timing. I mean, I could get up here and sit here and try to pinpoint a day, but I mean, I don't think anybody with any certainty can do that. So I think you're looking at kind of midpoint of 2025 as that inflection point. I know we've got another question before we wrap up here.
Quick follow-up on that. Have you guys done that analysis, the authorities exiting the market geographically? And if so, like, is there tendencies of authorities leaving in one area of the country versus other?
I haven't seen it. We've really done it just on a national level. It's one data set. That's a question I actually get asked a lot, and am going to spend time after conference season kind of wraps up diving into that. I think a lot of it's been, what we have done though is look at relative like age and authority, and a lot of the ones that have been exiting are those new authorities. So I think that's one of the areas that a lot of those that came in, call it in the last 3 years, those are the ones that are exiting. You're starting to see that average age of exit starting to creep up, which tells me the operators that kind of dealt with throughout the entire pandemic, kind of maybe even 2019, those are the ones that are starting to feel the pressure in this market, considering it's end of 2022 into now. I mean, you're talking over 2 years of a freight recession ultimately. So I think that's really one of the areas you're seeing that. Now, I will add, I think it goes into the interest rate thing and why maybe capacity's been kept around longer than many thought, because I know if you look at our CEO, Craig Fuller, he talked about very bullish on the back half of this year, and it's kind of not come to fruition. And I think one of the parts that got maybe, again, one of those areas that you don't really see until it's kind of in the rear view is the interest rate, or the loans that were given to these carriers have kept them in business. And it's not in a way that you think like, hey, if we have the loan, the banks don't ultimately want to call on these. They don't want to be in equipment sales. What they'll ultimately do is they're recouping all their interest early. I mean, if you think about your mortgage, what do you pay for the first, 15 years? You're paying majority in interest. The bank is recouping all their risk early in that cycle. The back half, you're paying it down. So different with an asset like a truck. Well, guess what? As long as you're continuing to make payments, they're just going to refinance you, give you favorable terms, work with you, because ultimately they don't want to take ownership of that truck. One, because it affects their balance sheet, because if you looked at used equipment prices, it's been reduced, I think a used truck is down 60% from its peak. They don't want to take that because they don't want to write it down on their balance sheet. They want to keep generating some level of bringing it in, and they don't want to ultimately have to go and sell that asset once they take ownership of it at a depressed rate, where they're going to get ultimately pennies on the dollar for what they issued that loan for at the beginning. So I think that's an element that kind of got, I don't want to say got missed, but there was so much going on in the market that it was one that kind of you didn't think was going to be as impactful as it maybe has been over the course of time. So with that, I mean, we're happy to answer any questions that anybody has. Yeah.
Sure. Hi.
Yeah.
Target. Are you seeing shippers in general maybe moving up RFPs and that's kind of... Hi.
Hey.
Are you seeing shippers start to move up RFPs or any sorts of things like that with the fact that truckload rates are supposedly at the bottom right now? Have you been hearing that, or is it seeming to stay kind of at that typical cycle?
I'll default to you on this one.
Yeah,
You talk to our
so
shippers.
I do support our shipper customers, and I think when it's mode specific, we are seeing a little bit of difference because, whether you're looking at flatbed, contract, and that project level space, the reefer market, those two modes have seen more volatility. Obviously, flatbed is now depressed. We could see that in the ISM PMI with manufacturing and contraction. I think, service being the number one indicator there, it is a little bit tougher because they have enjoyed very good service. And I think really the options that we're seeing now are looking more towards rounds of RFPs over the next 3 months because they have their own, fiscal years. They don't want to typically break from their RFP cycle. But instead of doing a whole network bid, they're trying to identify, okay, we need a set of lanes that are closest to the spot rate so that we can identify what might be at risk. Because as we can see with the connection and narrowing between spot and contract, and even earnings calls from companies like Warner and other customers that we've seen, these large asset-based carriers and assets have been talking for about 6 months now, identifying their areas that they can move their contract trucks off to the spot market when those times arise. And so I think it's moving more towards same timing potentially, but more of a measured and kind of round focus approach.
Yeah, and I think the other thing that I've seen a lot is an openness to an index-linked contract right now, where you're basically, instead of getting exposed to the market flipping, you're moving with the market and having that service component be really the value add. So call it, you have a 10 cent a mile increase nationally, call it 3-4%. Well, you're just moving with the market and your service stays the same. And I think that's been more on the shipper side right now, has been that focus on prioritizing the service even when the market changes and using index linked contracts and trying to find that, hey, how do we keep this relationship with our carrier base, make sure that they're not going to leave us high and dry like you saw some during COVID, and ultimately where we don't feel like we're drastically overpaying. I know I've talked with a couple customers and right now, beneficial. They work with one of the customers. I'm actually working on a use case study. The shipper does it, they use a broker to do it, and if the broker buys better than the market, and they pass that savings back along to a shipper. So shipper benefits, broker gets it because they know on the front end, what is kind of baked in, what their fee is going to be. And as the market moves, they can service the freight. They know how it's moving. They have these conversations, whether some lanes it's monthly, some months, or some lanes it's every 6 weeks, some it's every quarter. So I think that's been the biggest one. It's been just kind of this willingness to kind of gauge different approaches, knowing that kind of a market inflection is kind of in, I don't say the near-term horizon, but call it with probably in the next 12 months, you're going to see some level of disruption. So, anybody else? Awesome. Well, thank you all. I mean, we're happy to answer anything else. So.